thanks very much, everyone, for joining us this afternoon. It's great to see you here for another webinar with us. As I've just said, it's good to welcome you to TI, Apply and IRU's latest European road freight rate development benchmark for Q1 2023. It's been another really interesting quarter in the road freight market. It's always interesting. And I suppose one of the big transitions we've seen this quarter is really have moved into more of a buyer's market, as we've seen volumes drop off to some extent with demand slackening. We've seen more available capacity and a lot more companies going out for tender. In fact, speaking to many shippers, a lot seem to have 50% of their business out on tender at the moment, and one I spoke with yesterday was saying they reckon they've got 85% of their business out to tender at the moment. So trying to make the most of that change in conditions in the market, and it's our job really today to try and show you exactly what's going on in terms of road freight rates, how they're changing and the dynamics that are causing that, and to try and show you the way forward in terms of how rates are changing. So very happy to welcome you today. As usual, we'll have a 25 to 30 minute presentation where we'll take you through the overall situation in the European market, and then we'll take a look at some individual lanes and try to provide you with an outlook as to where we see prices moving from the very latest data. We'll also have a Q&A session at the end, so please feel free to add any of your questions into the Q&A tool on Zoom as you go through the webinar. We'll do our best at the end, as always, to answer as many questions as we can. We'll also be running a poll during this webinar as well, so we'll have a poll question for you in the first 5 or 10 minutes, looking at how we expect rates to come to change in the next few months. So please do participate in that using the poll tool on Zoom. All right, well, so I can now welcome you to the webinar and introduce you to our speakers. So I'm Michael Clover, I'm TI's Head of Commercial Development, and I'm your host today from TI, which is a provider of market intelligence and research on the whole logistics industry, actually, but provides lots of data and forecasts and insights about the road freight market too. So if you want to know what's going on strategically in the road freight market, you can come to us at TI. I'm also joined by my colleague Nathan Donaldson, who's our data team lead and an economic analyst here at TI and responsible for the analysis around the applied data in this report. So welcome, Nathan.
Thank you, Michael. Nice to be here. Hello, everyone.
Thanks, Nathan. And I'm also joined by Marianne Savoni, who's a Senior Manager of Strategy and Market Intelligence at IRU. So welcome, Marianne. And would you like to give a quick intro for IRU for those who don't know the organization?
Yeah, sure. Good afternoon to all. So IRU is the International Road Transport Organization, representing commercial road transport industry worldwide. IRU is counting more than 175 members, representing large logistic companies, national associations also in road transport, but also shippers, energy suppliers, and service providers.
Thanks, Marianne. And just before I introduce Thomas as well, just to read our disclaimer for you, we must remind you that all discussions and statements made by participants on commercially or strategically sensitive information may fall within the scope of competition law and be considered as unlawful. We invite you to refrain from sharing any information of such nature or entering into any such discussion, including during breaks. But now I can introduce Thomas Leroux, who's Apply's Chief Executive Officer, and has been part of every webinar in this series so far. Thomas, welcome. Could you just introduce yourself and give us a bit of background about Apply for those who don't know you, and then we'll move on to just a summary of the methodology we'll be using in the rest of the paper.
Yes, perfect. Hi, Michael. Hi, everybody. Apply is a tech company dedicated to the supply chain and the transportation world. We are providing a lot of services, including benchmark and analytics services, where we gathered a lot of data, transactional data directly from shippers, carriers, or freight forwarders. And this is exactly the data that we will use in this webinar and that we will analyze all together.
Thanks, Thomas. And we'll just move on to the next slide here, which is a summary of the methodology, just so everyone understands exactly what data we're looking at in this webinar. Thomas, could you take us through?
Yeah, I will follow on what I was saying. What it's important for you to understand exactly what you will see later, because we will show a lot of data based on real rates that we are collecting on the market, and it's important for sure to understand the rates that are behind that. We will talk today about FTL transportation, general cargo. We will have a look on spot versus contractual prices. The fuel is included in this analytics. We have often the question, why is the fuel included? Because we have a look on the all included prices. You for sure know that fuel is a sensitive issue because you can have several index depending on the countries. And so to have a global view on a European level, we decided to include the fuel on that. This focus will be on this data over there. We have, of course, much more data on our Upply side for LTL, for reefer, for bulk, for many others transportation. Here, the idea is to focus on this one, to have big ideas, and just also to introduce that you will see two types of indexes or two types of prices. One that is 100 based, meaning that this is a basket of different origin and destination. So this is not the price for a full truck on a specific corridor, but the basket of it. So it's 100 at a specific date, and then you can see the evolution. And on other graphs that you will see a price with the euro. So it's price for a full truck on the specific corridor that we will have a look at.
Great, thank you, Thomas. Yes, always good to have everyone understanding exactly what we're looking at. So now we can move on to the first content chart here, and this is the first index actually showing price change on a total European level. So this amalgamates all the rates from all the lanes we track for the webinar here to show us an overall trend. As you can see, rates falling both on the spot and contract market in Q1, which is first time they've both fallen for some time. Nathan, could you just take us through the circumstances in the market that have led to these falls?
Yeah, sure. Thank you, Michael. So really interesting view. If we look at the whole European picture this quarter, start off in the spot market. The spot market fell 7.5 points quarter on quarter. It's down to 132.5. Now, that's actually the first time that the spot market index has fallen for 2 consecutive quarters since quarter 2 2020. And that was at the start of the Europe pandemic response. So really significant data that we're seeing here. Additionally, the spot market index has now fallen down below its level at quarter 2 2022. And that was a time when we first started to see the effects of the Ukraine conflict becoming clear. Now, the spot index still remains up 8.9 points year on year. But then if we look over on the contract index, that fell 2.8 points, so a less severe fall, but that's the first fall for 6 quarters. So also a significant data point, and that remains up 10.7 points year on year. If we're looking at the dynamic that we're seeing, so the spot rates are now, they declined 1.5 times faster than the contract rates. And that's the result of falling demand from Europe, reducing the immediate demand side price pressure in the market. When we look at what was the cause of this, we can see that, well, we've got a combination of falling consumption with inflation being a clear driver of this. So despite inflation easing, year-on-year consumption is down 6% in Germany, 3.9% in France, 2.8% in Italy, 4.3% in the UK. So we've got a fewer volume of goods being demanded by European consumers, and that's putting less pressure on the market as we go through 2023. In addition, we've got wage growth that's lagging behind inflation, so we're likely to see this continue throughout the year as the real income of European consumers falls, and they're going to demand a lower volume of goods. So if we look over on the production side, now, the fears of a severe recession and an energy crisis has subsided, but what this has done is this left the continent with quite high contract rates in the energy market. So we've got a lot of producers that still have those high costs with the contract prices from 2022 continuing to keep costs high and deter production. So if we look at available data from 2023, we see that the UK production is down 0.5%, down 0.3% in Spain and 0.1% in Italy. We have seen some growth of 0.9% in France and 0.5% in Germany. When we're looking at the cost side and the supply side, which Mary will take us through in more detail, the reality is a higher cost base now. So it's clear that even though fuel prices have fallen, they remain up from historic prices in 2021 and 2020. We've got inflation that will drive wage growth, so we're likely to see increase from the labour costs in the market, so that's going to keep the cost base high, and the driver shortage continues as well.
Thanks, Nathan. Yes, so an interesting situation overall as we see the market going through a period of change. Obviously, thinking about the outlook for the rest of the year, we're expecting that demand to remain low through the first half of the year, hopefully recovering a bit further in the second half of the year. But also we've seen, and come to the stage, a bit of a seasonal uptick in prices now. But one thing we'd also like to do, as we have nearly 500 participants on the webinar, is to get your view as well as to how you think prices are likely to change over the next 3 months. So I've just launched a poll for you here, as I can see many of you filling that in already, asking how you expect prices to change over the next 3 months or so. And I'll just give you a little time to complete that. I can see over half of you have already done so. So just give you a few minutes, then we'll show you the results of that poll and have a look at what you are all thinking in terms of rate development. All right, everyone's still fitting that in. I can see now that there's a strong trend in one direction there. So it's pretty much in line with our thoughts and expectations there. It seems that everyone agrees, or most people agreeing with us as to the answers. Looks like most people have answered now, so I'll just end that poll and then I should be able to show you the results as well here. So should now be able to see those results. So we can see that almost half of respondents there have said rates will decrease slightly in the next 3 months. That's 49% of responses. 28% of you, so a good number, think rates will remain flat, and 9% think rates will decrease substantially. But a significant minority do think that rates will increase slightly, looking at 15% thinking that rates will increase slightly. So I think that's pretty much in line with the analysis that we've been providing, and sort of validates our expectations for the market. But does anyone have any comments on those results immediately? Thomas, any thoughts?
I suggest to keep myself for the end, because we will talk about it. Just a teaser, but the last slide of the presentation will be on the last weeks, on the month of April and the beginning of May. So it's good also to have this view on the last weeks.
Okay. Yes. See where the data is pointing, which after all is why we're here. So yes, no worries. Okay. Well, thanks everyone for participating in that. We'll move on now to our next slide, which is really looking at some of the supply side issues and showing the trend on fuel prices. So Marianne, would you just take us through this?
Yeah, sure. So as you can clearly see on the graph, the Q1 23 fuel prices at pump average were 9% less expensive than the last quarter, so the Q4 22 levels. And we can say that we came back to the levels of the Q1 22 prices, so before the war in Ukraine. What we can say here is that the average price on the main economies that you can see on the graph is about 1.7 euro per liter, and it was 1.9 euro per liter on the Q4 22. So what we can say, and it was exactly also what Nathaniel was saying at the beginning, the fuel prices show decline we could say the Europe economy shows sign of slowdown, and it is driven by 3 main elements. The first one is the highest number of refineries coming outstream. The second element of explanation, which is a strong one, is the fact that the export from Russia are rerouted or substituted by other partners. And today, US became the main crude oil supplier of Europe, 18%, followed by Norway, 17%, and Kazakhstan, 15%. The other element that we can say here is the the effect of the country's stockpiling in anticipation of the ban on Russian food. And the last thing to mention here, which is an important one, is that there is a very big uncertainty on what is going to happen during the year on the food prices. You have the recent escalations in the war. So you have the recent ban from EU, and also followed by the group of 7 advanced countries with a ban on Russia on crude oil imports since December 2022. And so this policy bore oil barrels from entering the EU directly, while allowing the world markets only to trade and refine Russian oil for sale in Europe if strict crude oil prices caps on its purchase are implemented. And the cap is $70 per barrel. So according to the European Commission, in 2022, 29% of extra EU crude oil was originated from Russia. And so the Russian decision to not accept this price caps will have a potential impact, which is going to be maybe less and less important, according to the fact that there is a diversification of partners, but we can expect a potential impact on the fuel prices during the year. So yeah, this is what I could say on this one.
Thanks, Marianne. Yes, really interesting to think about. Obviously, fuel prices coming down, but what the impact might be later on in the year as well on costs. So that's one sort of key element of the supply side, and Marianne's going to take us through some data, some more data on the on driver shortages as well in a moment, some new data from IRU. But we also wanted to provide a bit more of a picture as the demand side forecast as well. So this is actually TI's forecast for or latest data on projection from the first 3 quarters of 2022 for 2022 as an actual, and then a year ahead for demand development for road freight in 2023. So Nathan, could you just give us a bit of context for this, please?
Sure. So this is useful for this section. Now, obviously, we've covered the European view of what the actual gross on the country level look for consumption and production, and this shows it for the continent level. And this is really important in the section we're looking at at the moment as we talk about capacity, because we had that tight capacity and that quite strong growth in demand, which was really working to push the rates up. As we're heading into, as we're in 2023 and we look forward, we see that we've actually got the growth has dropped significantly from that 9.4% in 2021, and that's down to that 3.4% forecasted for 2022. And now we're actually going to give our actual growth for 2022 from TI coming in next month. But we look to see that just similar level, maybe a bit weaker than we expected during the year. And then so for this third bar, apologies, that says 26, and that's 2023. Now that's our forecast for the 2023 growth. And that's at 1.1%. So it shows that actually the demand pressure is really falling off as we head into 2023, as it looks like we're seeing more stagnant demand for the sector across the continent. And so it reduces that tightness in the market. Well, we also have that tight capacity, but we've got less pressure on the demand side, which is really forcing the rates up, while capacity stayed tight and actually fell in some places. But Marianne can take you through the driver availability to reflect that capacity now.
Thanks, Nathan. Yes, but very interesting to see the overall demand and spend on and revenue really in the road freight market too. So Marianne, here is the latest driver shortage data as well from IRU as well. An interesting story as we go into 2023 here as well. So could you just explain the trend we're seeing here?
Yeah, so what we see here is that there is still a high driver shortage, which is expected for this year. This is first estimations. We are still fine-tuning the data, but clearly we will stay at the same level than the last year. So what we can also say here is that 9% represent around 300,000 unfilled jobs. And what we can say also here is that the share of women is about 4% of the workforce in our last estimation. And the young drivers, so the drivers below 25 years old, are representing 8% of the workforce. So meaning that the lack of workforce will still continue to represent a pressure for the operators on the cost side. Something I wanted to highlight here as well is that there is a trend of a higher number of foreign drivers in Europe, notably in countries where there is an amount of international operations representing more than 20% of the operations. And also the countries, which is a quite important point here, the countries in Europe that have CPC process of qualification, which is a little bit more flexible. In Europe, you have three ways of to obtain the CPC qualification, and you have countries where it is possible for a foreign truck driver to get a training in English, which is the case of Lithuania, which is not the case in France, for example. So depending on the different qualification requested to get the CPC, of course, the share of foreign will be impacted. So just to finish on this one, because you see this is a continuous lack of workforce, and the road transport industry is asking to create an European framework for the recognition and the exchange of third country drivers' profession driving licenses. And so this will help bringing additional qualified drivers to the market from third countries. And when we say third countries, it means neighboring countries of Europe. So meaning notably the Euromed countries, meaning notably North African countries, for example. So just to finish on this, the European Commission is developing a concrete tool to attract this third country talent to the European markets. And it started with a pact on migration at the beginning of the year.
Thanks, Marianne. Yeah, so a few things being done there to try and deal with those issues as well. We'll move on then to our first actual individual lane here, and this is looking at rates on Madrid to Paris lane, so France, Spain. And we can see the trend on the chart there, but Thomas, would you just take us through this?
Yes, I will try to be quite quick on this one, and then because we have some others one. Here, what is quite good to see is also to answer to some questions. If you're looking at the gray line and the red one, you can see that the spot prices are below the contractual one. To see exactly that in some, what I want to say is that in certain corridors, you can find some spot prices that are decreasing sharper than the contractual one. And so you can find some spots that are indeed below. This is not the case in the majority of the lanes, as you can see it on the first graphs. But this is something also to look at. What we can see over there is that the spot prices are decreasing quite sharp, while the contractual one are not, I won't say increasing unless the black one, but needs something to have a look at, because here between Spain and France, it's a bit specific. We have the car industry that is quite strong, and we know that the cars industry is going quite well compared to the past months or quarters. We know also that the agricultural goods was very good at the beginning of the year. It was not the case in Q3 and in Q4. So this is just what I wanted to say on France versus Spain, and we can have a look on the spot versus contractual just after.
Thanks, Thomas. Yes, and now we can move on to Poland, Germany here, where we see again falls across the piece really. Nathan, could you just talk us through what's driving this?
Sure. So on this lane, if we look at the head haul, so we're looking into Duisburg, we've got contract rates which fell 2.4%, so quite a shallow fall, but they remain up 24.7% year on year. And then we've got spot rates that fell more considerably, so 6.6%, but they do remain up 16.1% year on year. When we look at the backhaul, we're looking into Warsaw, we have contract rates that fell 2.1%, so again, quite a shallow fall, quarter on quarter, remaining up 10% year on year, and spot rates that fell a significant 8.3%, leaving them up just 3.6% year on year. So if we're looking at the spot versus contract, the spot rates in the head haul are now just 12.3% more expensive than the contract rates, and that's down from 17.4% in the previous quarter. And that's a result of the spot rates falling at 2.5 times faster than the contract. This is a result of weaker immediate demand. So as I mentioned through the European section, the immediate demand is lower, and we've seen falling costs as well, which will affect both markets, but the immediate demand and less pressure affecting the spot market quite significantly. So German industrial production grew slightly for quarter on quarter, thanks to B2B growth. But the B2C focused production is looking like it's going to trend downwards. So that's putting less pressure. We see a 3.2% quarter on quarter fall for durable goods, and consumer goods grew just 0.1% if we're looking at production. Diesel prices in April were down 26.6% versus their October levels. So we've got a cost base that's allowing falls in both markets. Now, receding recession fears and energy crisis fears have allowed some shallow, have limited the falls on the contract market. And then if we look over at Poland, recent high inflation of 18.4% in February has dropped only to 14.7% in April. So still staying quite high. And that's causing a fall in consumption, significantly reducing the volume of goods demanded from the Polish consumers, and that's putting less pressure on the market. So it's allowing some falls in both markets, but specifically the spot, which is seeing the immediate pressure reduce.
Thanks, Nathan. Just a quick question that we had was, what does C and S stand for? So C is contract rates and S is spot rates, just in case anyone else is wondering. All right, we'll just move on to the last major lane now. And this is looking at France, Germany in this case. And again, we see falls across most of the lanes, apart from the spot from France to Germany there. Marianne, could you take us through the trend here?
Yes, sure. So when you take the head haul from Duisburg to Lille, there is a contraction rate of 6.5% that we can see. And the spot rates also fell by 9.6%. On the back haul into Duisburg, contract rates fell 2.3% quarter on quarter. And the spot rates grew on the other side, 1.9%. Quarter on quarter to reach 575 euro. So this is in stark contrast to the rest of Europe, with only 13% of spot rates rising in Q1 23, and so the average spot rate change behind a 4.2 fall. So what we can say here, the volume of manufactured goods consumed in France fell by 0.3% compared to the previous quarter, and is now down 3.4% year on year. This drop in demand for goods is resulting in low levels of demand side pressure, which is facilitating a fall for both spot and contract rates on the head haul. Despite a weak industrial growth, the French industry is still resilient. In the available data that we get from the National Institutes of Statistics and Economic Studies, put the total Q1 23 manufacturing down 0.4 points compared to quarter 22 and up 0.8 points year on year. Many manufacturers locked into high price contracts, keeping in fact the cost high and limiting the demand for German capital and intermediate goods, and thus keeping the demand side pressure on the road freight rates low in 23. In Germany, the available data from the German Office for National Statistics show that the average monthly volume of manufactured output grew 2.3 points in Q1 23 compared to the last quarter, so Q4 22, with intermediate goods growing 2.9 points and capital goods growing 2.7 points. The total manufacturing output is now up 0.5 points year on year. So this growth represents a more positive view of the medium term for German industry, with a comforting sense of energy security, encouraging production growth. This facilitates the spot rate growth from Lille to Duisburg that we can see here in Q1 23. Just to finish, when we look forward, the high inflation, as we mentioned at the beginning of the webinar, will continue to limit the growth of the consumer goods demand, and high cost from energy prices will limit the country competitiveness in the international consumer market in H1. And finally, the small businesses struggle and will continue to struggle with high cost and lack of competitiveness and consumer demand. And it's likely spot market rates will fall again in 23.
Okay, thank you, Marianne. Yes, so interesting differences between some of these lanes here, with different dynamics going on. Certainly on the Spain to France lane, as we're seeing across the other two lanes here. We'll move on actually on the subject really of German industry, looking at a different lane to usual this time, looking at Germany to the Czech Republic. Nathan, could you take us through this one? Might have to be a little brief as we're running a bit late, running a bit long today, but if you could take us through the main points, that'd be great.
Yeah, sure. So we look at the contract prices on this lane. So if we look at the head haul to Prague, fell by 6%, and main up 12.5%. And the spot market into Prague fell by 4.7%, but remains up 15.4%. So similar story where the rates are still up versus previous years, quite considerable. Contract rates on the backhaul, so that's into Duisburg, fell by 4.6%. Remain up 8.1%, and then the spot rates into Duisburg fell by 4.2% quarter on quarter, and that leaves them up 21.3% year on year after a very significant increase earlier on in the year. And what we're seeing here, this is again similar to what we're seeing in other places. If we look at retail sales, total Czech retail sales, Czech retail sales decreased 14.5 points year on year. If we look at the latest available data, with vehicle sales, spending on clothing and fashion declined quite significantly, with a fall in discretionary income. It's showing the consumers are now becoming more cost conscious and demanding a lower volume of goods, especially non-essential goods. And then Germany, really similarly, again, we're seeing that the B2B industrial growth seems quite steady, especially from the improved situation from Q4 and Q3 last year. But consumption is really, the B2C industrial output is quite weak. We can see that the consumption on the Czech end is quite poor, and then this will reflect in the demand from those companies, and it's going to weaken pressure. One thing to note on this is the effect of strikes. So in Germany, we've got the transport strikes, and that doesn't affect the logistics sector, but it is believed that it could have some knock-on effects affecting delays, costs, and capacity for German logistics.
Okay, thank you, Nathan. And then moving on actually to a view on a slightly different type of data, really, because as Thomas mentioned at the start, we're mostly focused on international rates in this webinar, but we do want to highlight some of the domestic rates that I have available in this particular chart here is looking at Italy domestic rates. We also have a view as the international rates for Italy as well. But Marianne, could you just take us through the domestic situation in Italy, please?
Yeah, this one is very interesting. So you can see in this Italy domestic rates index that the contract rate increased 3 points quarter on quarter, while the spot market fell 4 points quarter on quarter. So there is a big difference in terms of trend. Domestic contract rates were among the few that rose in Europe, as you saw during this webinar. In fact, last year Italy faced unprecedented weather conditions with record of the temperatures and also the lack of water, and notably on the main river Po, and that have severely impacted the waterborne transport and irrigations. The Farmers Union already warned of a record low harvest, but in fact some regions, and it was the case of notably Tuscany, produced better than expected the volumes and quantities of olive oil in the winter harvest. And so as a result, there was a greater competition for customers to secure the capacity in the contract market, which added demand side pressure to the market and pushed up the rates. Also, what we can say here is that, and this notably the case for Italy, in Q1, the diesel prices were still are very high. The average for Italy is at the end of the quarter Q1 is 1.8 euro per liter. So this is affecting the freight rates as the government's fuel discount expired. This pushed diesel prices up by 11% only when you have a look on January. While rates in mid-April have fallen by 16% from their post-Ukraine war, high prices remain up by 19% compared to April of 2021. So this indicates a higher cost base for Italian carriers. There is a pressure on the government to reduce fuel duty, which represents 50% of the cost of fuel in Italy.
Thanks, Marianne. And if we look actually at the international rates, then we see a similar story. But Nathan, could you just take us through the drivers of this that are different, if there are any, to the domestic market?
Yeah, sure. It's a very similar story. Where we're seeing all the rates fall apart from the contract rates on export lanes. So we're seeing that the effect of companies trying to secure that capacity after a very different situation in quarter from the dire situation we saw in quarter 3 and quarter 4, especially for the agricultural market. I would say that the main thing to pull out of this is what we can see in terms of the contract rates rising. So other places we've seen the main cause of the gap between the markets being the fall in spot rates. Here we saw contract rates rising, so that reduced the gap in the spot rate. So an example being Milan to Warsaw. So if we look at the export lane to Warsaw, the gap is now 21.5%. So spot rates are now 21.5% more expensive, and that's down from 28.5% gap in the previous quarter. So a significant change there and heading downwards and coming a lot closer. And then if we look at the import leg, so into Milan, the gap between the rates dropped from 13.7% to 8%. So we're seeing the markets come a lot closer together, but actually this is a different driver. That's the contract rates increasing and being a big driver there, rather than the spot rates falling, but they are also falling. So very different situation.
Okay, brilliant, thanks, Nathan. Now, obviously, all this data ends really at the end of Q1, so that's the period we're looking at with this data, but we do want to show you as much as we can an outlook as well as to where we think things are going, and obviously Apply data does run on a weekly basis more regularly than that. So we've also included this chart here looking at Lille to Duisburg to highlight some of the more recent data, and this also gives us an opportunity to look at what the data is currently showing us, the very latest on pricing moving, and how that relates maybe back to our poll earlier on. So Thomas, could you just talk us through this?
Yes, and the first comments I just seeing that we are talking about euro per kilometer. I'm looking at you don't see the euro on the left of the graph, but this is euro per kilometer. What you see over there are weekly fluctuations. So the gray part are weekly fluctuation for spot and contractual from France to Germany, and in red or in blue you have the monthly average, the quarterly average. Sorry. So what is interesting in this one is that you can see the last months and the last week, because this has been extracted yesterday. And once again, I want to talk about spot versus contractual, and this will answer a bunch of questions that we have received that are very interesting. We can see on the red part over there, for instance, if we are looking at the gray weekly, week-to-week prices, clearly spot prices are above and sometimes below contractual prices, and this is, from our point of view, something that is showing that there is a lack of demand, or that the demand is lower than previously on the market. Clearly, on the 2022, the demand was very high. We had a shock in the capacity of transportation that were available, and spot prices were above almost all months or all weeks of the year. We can see in many corridors, and this is the case here in the red one, that today, or at least over the past months, or the first quarter, the demand is lower. We have more trucks available because of the demand that is lower, and sometimes the spot is better. We are better off going on the spots. And in a globally speaking, we think that it's very important for shippers to have a mix between spots and contractual. You want to ensure for sure have contracts to be sure that to have a truck that is coming on the Monday, Tuesday, and for your supply chain. And sometimes because market is changing, because sometimes you have more or less demand, spot is very important also to have and to manage properly. So this is what I wanted to show. We wanted to show with the last week of data. The first quarter by habits on the market is a first quarter that is quite, let's say, cool. Just after the end season, we have rates that are on a seasonal basis decreasing a bit, and we need to have a look right now on May, June. Usually rates are going up over the past years. This is the big question. Demand is still low. Capacity shortage is still here, but if the demand is still decreasing, maybe rates will keep stable or continue to decrease a bit.
Yes, absolutely. So, that's interesting when thinking back to the poll. It was showing mostly a slight decrease and stable rates as well, but always good to think about the outlook there. Okay, so that does take us to our Q&A session. Thanks everyone for listening, and if you've got any further questions, please do let us know, but we'll do our best now to answer as many as we can. I have noticed a few people asking whether or not the presentation and report will be sent out after this. Yes, that's something I forgot to mention at the start. So you will all receive a copy of the report and presentation. So don't worry too much about that. Okay, so we are looking at some of the questions here then, and if we I have a couple of questions about driver shortages and about the sort of drop off in demand and how come there's still such a strong or such a large shortage. So I think first of all, it's important to say that the demand forecast looking for 2023 is actually looking over the whole year, 2023 ahead. And so that kind of irons out some of the lower volumes that we're seeing now with the later in the year period showing higher situation. So now if we've got drivers too many too much capacity for loads available, that's we're expecting that to unwind, but obviously we're also seeing a drop off, a slight decline in that rate of driver shortages as well. And I don't know if you've got any comments you'd like to add to that, Marianne, at all.
Yeah, just to comment also on this 9% that I just presented. In fact, this is not we could say a decline. I would say that it is more a continuity of the lever that we have seen last year, which is really following exactly the trend you just mentioned, Michael. So this estimation is showing that in fact the shortage is at the same level, with a demand which is indeed having an impact on the road transport volume, which is going to be quite in the same trend as the last year. So this shortage is just showing that in fact there is still not solutions enough implemented to then mitigate the risk. And that just to also mention something, because there was a question on the age of the drivers, the fact that there is 1/3 of the workforce having more than 55 years old. So you imagine what does it mean in terms of the coming years, where there is going to be the wave of retirements. This is going to create a huge impact in the coming 5 to 6 years if there is not enough concrete and short-term solutions implemented to mitigate the shortage.
Thanks, Marianne. Yes, and you've also answered another one of those questions there in terms of drivers' ages as well. So thanks for covering that. We've had another question here just on the subject of driver shortages, then we'll turn to some of the questions on demand and price change and what's influencing that. But one other question we've had here is just asking if we have new drivers from outside the EU, do you expect them to be paid on the same level as EU drivers, or would prices lower a bit with lower wages? I don't know if you have a view on that, Marianne.
Yeah, there is not yet a clarity on that. This is going to be clearly something to be tackled by the European Commission in the Pact of Migration. But yes, indeed, it is going to be one of the discussion. What is going to be the wages of these foreign drivers coming to Europe? So let's see. When we have more clarification, we will share it with you. Yeah.
Okay. Thank you. Yeah. Okay. So changing gears slightly, we also have some other questions here asking about what we think are the biggest impact on rates. So one here that maybe for Thomas, asking what is the main leverage of rates decreasing in Europe? Fuel decreasing or market and demand decreasing? Thomas, it looks like you'd like to answer that one.
Yeah, for sure. The fuel is part, of course, of a big part of the truck cost, of the transportation cost, so between 30 to 35%. It depends if we are taking all the costs in consideration. But I mean, this is an external cost, let's say. Of course, if you're buying on the spot market, it will be directly included in the price of the spot. If you're in a contract, usually your contract is based on an index, of fuel index that might have some lag. Or if you're going through certain countries, it can be a mix of different indexes and can be a bit tricky to follow. But what is very important, I think, is leave apart the fuel, try to see exactly what is the driver of the increase or decrease of price right now. Driver shortage tends to keep the price going up, but as we saw it, and we clearly see it today again, is that if the demand is not here, and for many reasons, and I will just add a new reason also that we don't talk that much here, is that the shippers have stocked a lot. They've bought a lot of goods over 2022. The demand is not here. It was not here at the end of the year, and right now because of inflation mainly. And so the demand for transportation is quite low. So I think the main driver, at least the one that we need to have a look at, is the demand for transportation. And demand for transportation is lower than expected or at a low level, and this drive prices downward. And if you add in addition the fuel that is decreasing, for sure the decrease is sharper.
Yeah, definitely. It's very interesting to see the impact of that, and certainly, you know, I think a lot of people in the market now would say that the drop-off in volumes is one of the big issues that they're seeing affecting pricing. So, yeah, there's another question here where that you've put your hand up to answer. Thomas asking about saying that spot rates are low in the contracts. They're seeing contract prices dropping marginally, but actually seeing recently substantial growth in spot rates. So do you have a view on why we're seeing that, or if you expect to see that carry on?
It's can you just repeat?
There's a question that you've flagged to answer here, which is saying we also see that spot rates are lower than contracts. And contract prices
sorry. Okay. Because I already answered to this question directly in the chat, but I will do it again because I saw that many questions were behind that. We see on certain corridors that spot prices are lower than contractual one, for sure. This is not the majority of the cases, at least in all the corridors that we can cover in Europe, because for sure when you're coming and secure rates over a year with high volume, you usually have better deals than spots, and this is normal. Spots usually you want to have a truck that is going out tomorrow from your warehouse, so you pay a premium for that. But I will just repeat one thing, is that when you see on the data that the spot prices are sometimes below the contractual one, it shows, from my point of view, that the demand is lower than expected, or that the demand is lower than the offer. And so this is showing that if it continues to go like that, contractual prices will go down and follow the spot one. I think this is the good insight to have a look at.
Yeah, we see that quite a lot in quite a lot of the data, don't we? Okay, and maybe a question for you, Nathan. We've seen a question here saying, how does the demand impact in 2023 tally with your slide for 2023 demand, saying that would be 1.1% growth versus 2022? Do you expect demand to pick up in the second half of the year? So Nathan, what do you think about that?
Yeah, sure. So our demand forecast is based on a really holistic top-level view of the demand, but we're also considering all parts of the demand, whether this might come from consumers, whether this might come from retailers and producers. And then obviously when we're analysing this, we're looking at more of a short to medium term indicators of demand. But I would say that one thing is that we're seeing is that while consumption has been trending downwards and we have pulled out quite a few negative production figures, some of the production figures are actually more positive, especially from the scenario that we saw last year, where there was real hesitation to increase output, especially on the production side from energy crisis and then around the interest rates. I would say that actually we're seeing more of a stagnant level of production. So when we look at the picture as a whole for the year, we actually see that minimal 1.1% growth for demand. And yes, in some areas it's falling, but if we pull everything together and we look at the total continental growth, then also this is covering every country. So it's not just the main countries that we're looking at and where we're seeing some significantly more pessimistic view of demand. So it is going to be quite varied for the year, and we're not heading for an extreme drop.
Okay, thanks, Nathan. Yeah, so it's a bit of a story of the sort of progress of the year and changing economic situation, really. We've also had a few questions just asking about whether intermodal prices are included in these lanes. Thomas, you're probably best to answer that.
Yes, the question of multimodality is quite interesting and quite key, because more and more people are trying at least to go to by rail or by boat. And so to be precise here, the data is only road transportation. And the question was also linked, will it have an impact directly on the road prices? I don't think so from my point of view, because usually the price of rail, for instance, is very aligned with the road, even a bit higher than the road transportation. But in multimodality, we can also talk about the boats and the nearshoring, because we see more and more factories that were in Asia moving to north of Africa or to the eastern part of Europe or to Turkey also. And here you need multimodality, you need to have nearshoring, having boats that are coming to Europe. And it means also more shipments in truck, so higher demand of road transportation in Europe. And this can have an upward pressure on the prices with a higher demand compared to containers that can arrive directly in Rotterdam, in Hamburg, or in Europe.
Okay, thank you, Thomas. Okay, well, it's almost 5 to 4 European time, so I think probably best to draw to a close. But thank you everyone for joining us and attending again. We'd love to carry on the conversation with you. So if you have any questions about the markets, you can contact TI about rates, supply, and any questions about changing regulations or changing market conditions. I'm sure IRU would love to hear from you. So please use the contact details on your screen if you'd like to carry on the conversation with us. It then remains to me really to thank our panelists, Nathan, Thomas and Marianne, for joining us to give their insights once again, and again to thank you all for coming. We hope to see you in the next webinar for Q2.